Welcome back. You're still tuned into Power Breakfast on CNBC TV 18. A lot of big names that reported numbers yesterday post-market hours. So let's talk about them now. L&T is in focus after reporting a good set of second quarter numbers. Vivek is joining us to tell us all the highlights and the analysis as well. Vivek?
Well, good morning. All eyes were on, the construction major to see, what kind of numbers, and the company has not disappointed the street. It's a strong set as far as L&T is concerned, while the core margins were a bit of a concern, in the conference call. Management did actually go ahead and allay most of the fears that the street had. So talking about the numbers, revenues came in slightly over 42,750 crore mark, above the CNBC TV 18 poll. When you also talk about the EBITDA also came in close to the 4,900 crore mark, again above estimates. Margins again, flat on a year-on-year basis, but on a good trajectory. The core margins were a slight miss. It was softer both on a sequential as well as on a year-on-year basis. When you're talking about the profitability, coming in close to the 2,228 crore mark. The most important part is in the conference call, the management maintained its 12 to 15% year-on-year growth guidance as far as order inflow as well as the revenue is concerned, with upside risk as far as margin. They believe that the company should be able to touch the upper band of this particular guidance. So when you're talking about the core margins, the management explained that it was on back of a softer project mix as well as raw material price volatility. That was something that impacted the margins. When you're talking about key updates, the road assets that the company has said that in this particular quarter, most likely they would be signing an agreement to completely exit most of the road assets that they own. And, of course, this particular deal would be subject to most of the necessary conditions. And lastly, the Hyderabad Metro divestment is something that the management is working on. They believe that it will take a couple of years to actually go ahead and divest this project.
All right, okay, that is L&T. The stock will be reacting to its earnings today, but that's not all. Even Tata Steel reported numbers, but it looked like a disappointing set of second quarter number, Nigel.
Well, that's right. Morning. Sonali, the numbers are disappointing. We look at the consolidated number, and that, in fact, was a miss in comparison to what our poll threw up. So even the margins did come in lower, so that was a miss. That's the headline miss. But for Tata Steel, as we always say, we look at the EBITDA per ton for India as well as in Europe. And on the India business itself, there was a miss. It came in at around 8,800 rupees per ton, or we were working in the vicinity of around 10 to around 11,000 rupees odd. For the business on the whole, there were two big reasons. One was that the steel prices did correct. The second factor is there was no benefit of lower raw material costs because they were sitting on high cost inventory. For the Europe business, well, it was expected to be a bit of a contraction on a year-on-year basis, but that number is more or less in line with what the street was working with. It had a double whammy actually in Europe. In India, you had volumes that were higher, but in Europe, there was a degrowth out there. And in spite of that, it came in more or less in line. The third factor is that the net debt number, that spiked up by close to around 17,000 crores on a Q-on-Q basis. That's primarily because, they purchased NINL. They have their capex plans that are ongoing, and also they paid out dividends. So that explains why it did go up. Well, I spoke to the management on the conference call. We had a call late last evening. And in fact, they said that the benefit of lower coking coal prices, that's what will benefit them in the coming quarter. They gave a number. They said $90 for India and around $100 for Europe. But they also went on to say that in Europe, the second half of the year, the EBITDA will be weaker than the first half of the year, though went on to also add that it will not go into the negative. In fact, let's hear out what the Tata Steel MD and CEO had to tell me on the call yesterday.
Most of the coking coal we used was coking coal that we had bought in the previous quarter. So we really did not get any benefit on an average. Of course, the coking coal consumption cost in September was lower than July. But July and August, it was actually moving upwards rather than downwards. So we'll start seeing the benefit in Q3. Europe may be about $100. India would be about $90. The second half for Europe will not be as good as the first half. That is clear. Simply because the rising energy costs would have an impact, though over the last 3 weeks, as you would know, the gas prices have dropped very significantly. So maybe Q4 will not be as bad as we thought it would be. No, not negative. It won't be negative, but let's see where it is.
Okay, that is the word coming in from Tata Steel. But finally, Bharti Airtel too reported